Welcome to Illuminati Silver's Inner Sanctum, where we tell you the truth about silver, precious metals, economics and politics. Today is Sunday, the 14th of April 2019, and we're discussing the recently released World Silver Survey 2019 produced for the Silver Institute by the GFMS team at Refinitiv. On Friday, we broadcasted a video to all of our YouTube subscribers on this subject, but it just touched the subject superficially. In this video we shall go into more depth. However, first we shall precis what was said in the general video. There were 8 major notable headlines in the report. 1. Physical demand for silver increased 4% in 2018, propelled by a modest rise in jewellery and silver fabrication, and a jump in coin and bar demand. Indeed, investment in silver bars and coins grew by an impressive 20% last year, driven by an exceptionally strong demand sentiment in India. 2. Industrial fabrication lost 1% last year, which slightly reduced its market share from 59% to 56%. Solar panel demand actually fell slightly for the first time in 3 years, mainly the result of excess inventories to be cleared, as well as thrifting, though this was partially offset by an increase in electronics and brazing alloys and solder sectors. 3. For the third consecutive year, silver mine output fell, declining by 2% last year, driven primarily by the lead and zinc sectors. 4. Scrap also declined some 1.6%, primarily because of the near 8% decline in the silver price, which, combined, resulted in pushing total silver supply for 2018 down by 3%. 5. Coin and bar demand were up nearly 31 million ounces, over 20%, though the figures are still lower than each of the years between 2013 and 2016. 6. The physical market showed a deficit of 29.2 million ounces or 908 tons, which is approximately 3% of annual demand, as total supply were 1,004 million ounces against total physical demand of 1,033 million ounces. 7. Taking into account ETP inventory build and exchange inventory build, the deficit rose to 80.1 million ounces. And 8. The LBMA silver price averaged $15.71 an ounce in 2018, down by 7.8% year on year. Trading took place within a $3.55 range, reaching a high of $17.52 and a low of $13.97. So the major talking points for us here are to assess what these figures really mean or suggest. How are they likely to impact in 2019, and what, if any, effect are they likely to have on price? Before we do that, many subscribers have asked what are ETP inventory build and exchange inventory build. Okay. Without going into too many technicals, ETP inventory build, ETP stands for exchange traded products, and these are loosely defined as a type of security that is derivatively priced and trades intraday on a national securities exchange. ETP is a price, so the value is derived from other investment instruments, such as a commodity, a currency, a share price, or an interest rate. So in this case, in terms of silver. The largest single ETP is iShares Silver Trust, with a balance made up of mainly ETFs, which are exchange-traded funds. investment funds traded on stock exchanges, much like stocks. An ETF holds assets such as stocks, commodities or bonds and generally operates with an arbitrage mechanism designed to keep it trading close to its net asset value, although deviations can occasionally occur. Now, exchange inventory build is the change in exchange inventory. When in total they are net sellers, this will be listed as a negative demand figure, and when in total are net buyers, this will be listed as a positive demand figure. So, combined, according to the report, and we're quoting it directly, the small physical silver shortage was absorbed by metal made available from exchange-traded products, which recorded net sales of 20.3 million ounces last year, only the third recorded net decline in ETPs this decade. A 38% net rise of exchange inventory build, however, pulled metal into the various global warehouses again, pushing the net balance to a deficit of 80.1 million ounces in 2018. So this is how we move from a deficit mentioned earlier in physical as difference between supply and demand from 29.2 million ounces to 80 million ounces. So let's now attempt to draw some analysis from the figures. And by the way, there is a link below this video for the Silver Institute Silver Survey report. We shall be looking at 3 features, otherwise this video or report will be a few hours long. So the 3 features we're looking at are coin and bar demand, mining supply, and the gold to silver ratio. Firstly, let's look at coin and bar demand. It rose by 4% compared with 2017. Now in itself, it's quite exciting. It suggests that investors are once again developing the silver purchase habit. However, let's look at this a little more closely. According to the report, quote, silver coin and medal fabrication declined for a 3rd consecutive year in 2018, falling by 4% to 82.6 million ounces. Since hitting a peak in 2015, coin and medal fabrication has slipped by 40%, with the approximate value of investment in this category falling to $1.3 billion from $1.5 billion in 2017. Similarly, comparing fabrication results to our GFMS proprietary quarterly bullion survey, weakness in coin sales was also recorded in 2018, with annual demand for bullion coins falling by 4% year on year, making a 3rd successive year of declining demand. Unquote. So you may ask, well, how have these coin and bar figures risen then, if the demand for coins are down by 4%? The answer is again, according to the report, quote, following 2 consecutive years of annual declines, global physical bar investment rose a whopping 53%, reaching 98.7 million ounces in 2018. Although still modest compared to the peak of 157.5 million ounces in 2015, the rise was well overdue and completely attributed to an exceptionally strong demand sentiment in India. South Korea also recorded healthy growth. Unquote. Interesting. So when you see the pumper headlines, Silver Eagles sold out, or coin demand going through the roof, well, actually, it isn't true. Yes, Silver Eagles may be sold out. And as we portrayed it in a previous video, there are often a number of reasons for this, but not that either coin sales are going through the roof or that there is necessarily a silver shortage, as some lay claim. we've already seen 2018 coin demand down 4%. Now, India's increasing silver acquisition has been due to a substitution effect with gold, which has become far more expensive for them and difficult to obtain. This fact is comforting for us collectors, as it does show there is a substitution effect between gold and silver to some degree, and as gold prices rise longer term, silver demand will therefore increase, thereby affecting its price too. Now let's take a look at mining supply. According to the report, 1. Gold-silver mine production declined by 2% in 2018 to a total of 855.7 million ounces. 2. Silver mine supply decreased by 21.2 million ounces, the third consecutive drop after 13 years of uninterrupted growth. 3. For the second consecutive year, the biggest year-on-year variation was posted by the primary silver mines. Less pronounced drops were witnessed in silver sourced from other metals. In other words, pure silver mines or primary silver mines are in decline in terms of its mineable silver. And 4, losses in the Americas were partly offset by a strong performance in Asia after a robust performance by India and China. So you will see that most of the growth is coming from the Asian continent. Now these are the sort of figures that many pumpers use to say we've reached peak silver, and they then extend these falls into the future, thereby stating that silver is running out. Well, actually, there were a myriad of reasons for mine supply reduction, and much of it the result of company difficulties at certain of the larger mines and pollution issues in countries such as China, many of which will have been resolved or mitigated before this year is out. But this is the figure we want our subscribers to pay close attention to, and we are again quoting the report. Quote, following 9 consecutive annual increases, identifiable above-ground stocks fell 3% year-on-year to 2,549 million ounces in 2018. Current inventories can cover 28 months of global demand. End quote. Now, what the report is stating is that if no silver is mined, 0, then there are sufficient available above-ground stocks to satisfy demand for 28 months. Now, let's think about this for a moment. We're not going to be in a position where there is 0 silver mining. Now, if we take the worst-case scenario of an 80 million ounce physical silver deficit, as indicated in the figures for 2018, there are sufficient above-ground stocks to cover a continual 80 million ounce year-on-year deficit for the next 31 years. Now, playing devil's advocate, and let's take the worst deficit since 2009, which was in 2013, where the deficit stood at 147.9 million ounces. Almost double the 80 million, not quite. Well, even then, there's still enough supply for the next 17 years, and no one is suggesting that silver will continue to have an ongoing mining deficit compared with demand. The report even indicates that it expects mining supply to rise in 2019. Let's quote them. The ramping up of operations in Argentina, India and Mexico are expected for 2019, with global production anticipated to rise, unquote. And this is what the report says about above-ground stocks. Quote, Above ground stocks were at their lowest in 2005 at just above 1 billion ounces, but have witnessed steady increases since then, reaching a peak of about 2.5 billion ounces last year. Unquote. The Silver Institute, or the report at least, is giving us all a very clear indication that not only is there a zero chance of a silver shortage, but even if mining was curtailed or cut back, but they are expecting it to rise in 2019, there are ample above ground stocks for many years to satisfy demand. Now, this is one of the main reasons we have said ever since our channel began, and since we ourselves began collecting silver over 40 years or so ago, that silver investment must be considered a long-term investment process. Yes, silver supplies will in time prove more difficult to reach or gain access to economically, but new technology may deal with that, and higher silver prices will make existing uneconomic mines economic again, and so a number of mines and or seams will be reopened. Now, if we were 20 years old today, or even 30 or 40, we would acquire silver with a view to it being available at pension age, and if the price rises before then great. Even at our ages, we still collect and invest in silver, but fully acknowledge that it is our children who are most likely to benefit from its accumulation. Now let's look at the gold to silver ratio. This is a subject that gets investors hot under the collar. Today, the gold to silver ratio stands at just over 86 to 1 in US dollar terms. Now the report quotes the following, quote, "After bottoming in 2010, the gold to silver ratio has increased steadily. The ratio retreated briefly in the middle of 2016 to close the year at 70.9, but resumed its uptrend in the middle of 2017. The gold to silver ratio can rally in the face of a crisis, although the nature of such a crisis would dictate how the ratio develops. If circumstances suggest that market instability increases, then investors generally would favor gold over silver. A good example was during the 2008 global financial crisis, when the ratio surged above 80. Gold is expensive compared to silver, or silver is cheap compared to gold over its long-term average of around 65. A high ratio in the early 1990s was in response to the Gulf War. It is arguable that in anticipation of a crisis, the market could see a ratio of above 80. At the end of 2017, the gold to silver ratio stood at 77, a high level that perhaps signaled another major crisis was looming. Indeed, the ratio finally reached the 80 territory again in February 2018 and moved sideways between 74 to 83 until September, when emerging markets entered into a liquidity and an investor confidence crisis. The ratio even reached as high as 86 in the first week of December. However, as both the US equity markets and the US dollar declined sharply shortly after, silver outperformed the gold price despite a weaker US economic outlook, ending the year at a ratio of 83.6. Unquote. Now that all comes from the report. So today we have a ratio at 86 to 1. And in the recent past, anything over 80 to 1, the pumpers and so-called guru investment geniuses encouraged investors to exchange their gold for silver. To some extent, and to be fair, we initially felt that was perhaps a wise decision too, until we seriously started to look at the relationship between gold and silver, and also assessed as to why silver is demanded in the first place. Now, silver is generally demanded for two prime reasons: industrial production and as a monetary metal, often referred to as poor man's gold. People often cite that silver comes out of the earth anything from 8 to 1 to 13 to 1, and allegedly the earth's crust has 19 times more silver than gold. Now, whilst these figures are difficult to assess accurately, in physical mining terms, in 2018, a little over 3,000 tons of gold was mined and 26,000 tons of silver, a ratio of just 9 to 1. With this in mind, those who wish to advocate a considerably higher silver price put forward the hypothesis that on that basis, with gold at $1,300, silver would be $140 an ounce. Well, this calculation is so false that we find it difficult to believe that we continually have to argue against this nonsensical hypothesis. Firstly, gold and silver are not perfect substitutes, and also their interrelationship varies. Silver is an industrial metal as well as a precious metal, and this has an impact. For if such an assessment were to take place, based on what is mined, then platinum, which is only mined in quantities of around 180 tons per annum, should therefore be worth $23,400. In other words, $1,300 times 18. As gold is mined at 18 times more voluminously than platinum, compared to the $900 or so an ounce that it is, $23,400. And we certainly haven't heard the same people make that argument, but they do about silver. It's all down to supply and demand, and what people quite frankly are prepared to pay for something, and their substitutional effects. If gold and silver could only be used as a monetary metal and nothing else, then an argument could be put forward to suggest linking it to mining, but that is not the issue or the case. Secondly, silver is demanded as an industrial metal, and as already mentioned last year, saw an absolute 1% decline, resulting in industrial demand falling from 59% of overall demand to 56% compared with other forms of demand. There were a number of reasons for this fall, not least being the lower demand for silver for solar panels, as there was excess inventory which needed to clear the market. In addition, the China-US relations have arguably had an impact, and so have the recent falls in many countries' GDPs. This is expected to continue into 2019, meaning that the demand for silver for industrial purposes is also likely to fall again this year. Now, unless this is made up via monetary demand, we can again see a reduction in the silver price. But even if no price reduction occurs, we can certainly see it fall further behind in the gold to silver ratio, as gold comparatively strengthens due to its higher monetary metal credentials. Do not be surprised to see that ratio gravitate closer to 90 to 1 later this year, if industrial demand does take a significant hit. Now, of course, if governments and central banks continue to create artificial stimuli through the easing of credit, then such a hit will not be so pronounced. However, that then in turn will have other longer-term implications. Now, in this video, we have focused primarily on three main factors from the report, but there are many more. Where demand growth is expected, where increases and declines in mining supply are also expected, why some countries are purchasing as much silver as they can and others are actually buying less. There is seriously too much for us to cover in depth here, but we strongly urge all of our subscribers, and particularly Inner Sanctum members, to spend a little time and read it in depth. As already mentioned, a PDF of the report can be obtained in a link below this video. Now, silver analyst Johann Weber predicts that industrial demand is likely to fall this year by about 1%, but would rise again in 2020 and 2021 as production of solar panels picks up and US coin sales expand. He also adds that supply would rise by about 1% in 2019 before falling again in the early 2020s. This will hardly benefit the silver price this year, save that he also expects rising economic and political turbulence, along with a likely weakening of the dollar to push prices higher, with silver averaging $16.75 in 2019 and $17.50 in 2020. Now, although broadly we agree with this assessment on demand and supply, we suspect that the US dollar may have some more strength left for a little while yet, and therefore believe his average silver prices to be a little optimistic, though not entirely out of the spectrum, and would shave anything from 50 cents to $1 from his predictions. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.